Hello and welcome back. My name is Josh, and today I wanted to discuss a company based on a suggestion from a viewer, Daniel. So, Daniel, thank you for the shout out and for recommending that I look at StitchFix. StitchFix is an online personal shopping company. It basically helps people shop by providing an algorithm that says, "Oh, I think you'll like this. I think you'll like that." So it gives a personalized view of kind of what clothes people should buy. And the stock kind of, I think, went public in 2017. I think that's the oldest it is. Yeah. So it's been mostly flat for a while. Then it shot up during, I'll call it the hype boom. So, when everyone was investing, and it's basically fallen right back down to their original levels. So, you know, there's a lot of question marks here. What's it worth? It's kind of gone all over the place. It started flat, then it shot up. Now it's back down to basically around where it was. So is Stitch Fix potentially a good investment? So first thing I'll say, so again, whenever I look at any investment, I try to look at it through my framework of like, do I understand the product? What's the macro environment? And then the actual valuation. So let's start with the product. I've never used Stitch Fix. I actually am the worst shopper in the world. I do not go shopping. I haven't really grown height-wise, I guess, or weight-wise. Actually, I've basically stayed the same weight and height since I was like 14. 5'8", 138. Like I'm pretty light. Actually, when I went to the gym, I got a little more muscle, but other than that, so I basically don't go shopping very often. I'm not really stylish, just being honest here. I mean, I'm wearing a Budweiser t-shirt, makes me happy, whatever. Not that I like Budweiser, but I like the shirt. So I can't really recommend the product, but I will say on that, the number one thing that I think people don't understand is people think they want choice, and they don't want choice. There's lots of research out there that shows that when you give people three jams to choose from, they're more likely to buy a jam than when you give them 20 jams to choose from. So if you let them try 20 jams, they will try a lot more, but they won't actually make a decision because choice, like we think choice is good, but it's not. When you have too many choices, it's overloading. It's overwhelming. The term for the thing is choice overload, and basically you want to give people fewer options, not more. So this is why I really do believe in the power of algorithms to make recommendations for you. So I use Spotify, love it, and I think it's made finding new music so much easier. Netflix recommends what they think you'd like. Sometimes it's right, sometimes it's wrong, but as you watch more and more, the recommendation engine gets better. So people think, oh, I think I know what I want. I've seen my wife try to shop online. It's like, do I like this? Do I like that? Too many options. And I do think there's value in something saying, hey, we know your style, we know this. Here's what you'd like. So while I don't understand don't know the actual product, I think the core thesis behind it makes a lot of sense. I think there is definitely value in a product that makes good recommendations. Now, again, are they good recommendations? I can't say because I don't use it. So if you have used Stitch Fix, let me know in the comment section below. I'd be really curious. So that's one. Two, what's the macro environment? So is a tech company which is typically good, which I like. I think that online shopping and e-commerce is only increasing. And so, again, I don't know much about the company, but I do have a thesis that there's a backstop, which means like it can only go so low. I could be wrong here, but I like investing in companies where I don't think I have too much downside and I think I have a lot of upside. I'll mention briefly Peloton, which I think I've done a video on before. So far, it's gone way down, and I've been completely wrong on it. I think it'll bounce back. I think they cut guidance a little, and the stock dropped like 40% because of it. But the reason why I think that it has less downside is I think if the stock dropped anymore, Nike or Apple would love to have Peloton, and they would buy it up in a heartbeat. So I think there's a backstop there. I don't think it will keep going down forever because someone sees value in this. I could see the same thing with Stitch Fix. This is a recommendation engine for personalized shopping. Why wouldn't Shopify, potentially PayPal, Amazon, like an e-commerce company, I think would love to have something like this and would buy them up if it dropped down to a certain value. So I think there's for sure going to be a backstop here. So I think that's good to know, and that's factors in the macro environment. Is this is a product that people are going to want, and it could become an acquisition target, which could also increase the value. So now let's look at the actual valuation. So StitchFix, if we look at the revenues, again, it's currently at 28.50. That's basically from here to here. It was 29, 23, 25, 23, 25. So it's a little higher than it was previously, but basically from 2018 to 2020, it was around 10% lower. And yet when we look at, when we look at the growth rate, like you can see here, it did stop dramatically that month. It dropped, not sure why. But the growth rate, it's significantly high. It's 2.1 billion in revenues right now, and it's previously at 1.2, so it's almost 80% higher, despite the stock only being 10% higher. So they do seem to have good growth. I would be curious why growth dramatically went negative and then slowed, but has reaccelerated. Could be something macro related. Again, I am not super familiar with this particular industry, but also the timing didn't seem to line up with COVID. Actually, sorry, it did, right? COVID was, yeah, sorry, my brain's off. I thought COVID was 2019, but it wasn't. It was 2020. So that's all this is. So it dramatically slowed during COVID, and then it's gone back. So that actually checks out. That's a good thing. That means that it's not an external factor that we want to worry about. This was something, I mean, it was an external factor, but it wasn't something else that we don't know about, like something within the fashion industry. This was COVID. Everyone got hit by this. Okay. Gross margins. I'm actually a little shocked that gross margins aren't higher. If it's an algorithm company, if it's a true tech company, you typically hope for 70 to 90% gross margins. Like Google, Amazon, Facebook, these, I was gonna say Microsoft, but Microsoft also sells hardware, and yet I bet Microsoft has higher margins than this. So I'm a little disappointed with their gross margins. So this means to me that they're not as tech as they make themselves out to be. If it's a true algorithm and that's all they do, gross margin should be way higher. Operating margins, well, we can see it went negative. I actually don't mind that. I know some people don't love it. It's bad if you're cash losing only if you don't have a good cash balance. So you would have to check, and we can actually check cash on hand. Where do we do that? Cash on hand. I am not. Oh, assets and liabilities. Cash on hand. Duh. Cash on hand. So they have 230, basically $250 million. So that's a good amount. Maybe they could use a little more, but typically when you have negative operating, you want to make sure you have enough cash to meet your things. Because again, if your cash flow positive or operating income is positive, it means you're adding money every time. When you're negative, it means you might have to go back to the market. So typically, like a company might go public to get that money if they're cash burning, but you don't want them to have to keep going back to the market because that means either there's a lot of debt, which is risky, or they have to sell additional shares, which means you're getting diluted. So this is a potential negative, but again, I don't look at the company solely based on the operating. It could be strategic. We could say, you know what, we're looking to grow more, which means we're trying to make more money, or it could be an operational failure. And again, to me, because it coincides with COVID, I think that it's likely sales decelerated, and that was a major factor, and they likely had to restructure. But you can see it's trending upwards in the right direction ever since sales reaccelerated. So I think this is again a macro thing, not poor operational efficiency. So now let's look at kind of the valuation. So one way to look at it could be price to sales. So again, I wouldn't do PE because again, it had negative earnings and it's a young tech company, so never look at it. But you can look at it price sales. So price sales, it was about 1.5, 1.6, 1.5, 1.3. Obviously shot up when the price went up. And but again, that's an outlier. That basically says, why is it worth 5 times more what it was a couple months ago when sales are only up like 5%? Doesn't make any sense. But it's basically at the current price, it says $30. It's actually a little lower. So it's probably about what the price sales was before. So to me, if you believe in the long-term company here, you should be even more into it now because it's bigger sales. Um, and yeah, I believe that. Same with price to free cash flow. Unfortunately, they're not making free cash flow. They were, and now they're in the negative, so we can't look at that. So let's look at the quick analysis. So market cap is 3, trailing 12-month revenues 2.1, right? 2.1. Yeah, 2.1, 3.1. Let's do 3.1. I do not want to give an exit multiple of 25. I don't think it's the highest quality business, so I'm going to go 20. And what are the operating margins? So this is the question. To me, the operating margins, let's go. It's tough. The only time they've actually been profitable, it was in the 3% range. With 40% margins in a tech company, I think it should be higher than that, but I don't think much. So maybe again, it's probably between the 5 to 12. And what do you think growth does? It's been growing at, sorry, where it was, revenue. Here we go. This is year over year, quarter over quarter, 20%, 20% again. Ignoring that, it's back up to 28%. So, if you go 20%, then 18%. If you 20% now and you think that it's going to decelerate, you could easily think it's 15%. And to me, even if it's 15%, they make 5% margins. Actually, let's be even more conservative, 2.5%. I think they can beat the 2.5% again. When they were profitable, they were making 3.5. So I think 5 is probably on the low end reasonable, and maybe there's upside. But to me, the company does look undervalued. I think it's interesting. Give me 1 second, and I'm also going to do one more thing. I'm going to look at it on Finbox, another one I like that does a DCF. Okay, here we go. Oops. And away we go. There we go. Okay, so let's update our assumptions, lower the discount rate, increase the terminal value. There's only a 5-year, they're only showing a 5-year one. I'm going to lower some of these assumptions. I don't think they'll make 12% EBITDA margin. Let's go to 10. Actually, what if they even just do 5? Nope, if it's 5. This is EBITDA margin, though. I do want to clarify, this is not operating margin. This is EBITDA margin, so a little different. But basically, if you think they can get, it does look undervalued. If you think that, and they have actually lower growth. They have 14% growth. I think it could grow even quicker than that. So I think this looks like a soft buy. I think it does look interesting. I'd need to do a little more research into some of the mechanics of the company. But my quick analysis says this is interesting. So to me, again, I look at, there's 3 buckets. There's this looks interesting, this looks bad, and too complex. And to me, this looks interesting. So I might do another video on StitchFix to do a little bit deeper dive into why are their margins only 40% if they're a true tech company. What does management think? I really like to understand management because again, to me, when you're investing in a business, if it's a well-run, oiled machine like a Walmart and it's just a cash flow machine, but still they have to adapt to the future. And who's making these decisions? Management. So, but especially with a young tech company where you can't value it as much on, it's more on about the potential growth. And when it's potential growth, it's all about execution and vision. It's like when you're investing in a startup, there's no business. You have to invest in the people. You have to believe that the people are going to execute. So with management, a smaller company like this, I know 3 billion, but still, it's a smaller company and not cash flow positive. You have to believe that the founders are going to execute, be able to find the right people to do the right things and launch new product lines to grow and become profitable. So I'd like to do more research into management. I'd like to do more research into why their margins are only 45%, but quick analysis looks interesting. So that's my thoughts. Let me know, do you own StitchFix? What are your thoughts? Let me know in the comment section below. Thanks so much for watching and talk to you next time. Cheers.